Okay, in this video, we're going to take a look at a key topic one or two of you have been asking me about, and that is what do the ratios I've been talking about through my video series reveal about Apple right now? And are we witnessing the start of the end of the tech boom? Before I dive into that, there's going to be quite a few ratios numbers mentioned. Just a word about a question one or two of you have asked me, and that is there a script to go with these videos? Well, the good news is my colleagues at MoneyWeek have put together a series of weekly emails called MoneyWeek Basics that cover most of the topics in written form that I cover. It's a weekly email series. They're available free, and if you'd like to know a bit more, just click on the link that'll appear in the description box below this video. Now, this week's topic is Apple a buy, a hold, or a sell, in my opinion? And how can you tell from the numbers? People have said to me, Tim, we've seen your PE ratio video. We've read the MoneyWeek Basics on price to book. All right, and what we want to know is this. Putting it all together, combining these numbers, how can you tell if a firm is a buy or not? Which ones are relevant and which ones aren't? I mean, after all, there are 10, 15, 20 basic ratios out there. How do we know what to conclude on a specific company when we apply them? Well, few companies are in the public eye right now more than Apple. Okay, for various different reasons. You might have seen that advert they do where they claim that the latest Apple product fits with the theory of evolution. A little bit of hubris going on there. The hand, look how it's designed to make the thumb go here and thumb go here, right? That's a sure sign of a top of the market company, by the way. One or two of you might have noticed they're planning to do a share buyback in the future and thought, that makes me nervous. In next week's edition of the magazine, I'll be dealing with why share buybacks make me nervous. That's MoneyWeek magazine for those people who've not come across it. And one or two of you might have noticed that their latest gadget, okay, is being viewed as a little bit price toppy by one or two of the analysts out there. So there are signs that the Apple edifice might be creaking. But that's all very well, it's anecdotal. What are the numbers, okay? What do the ratios reveal? Do they reveal the same picture, or do you not need to worry, okay? Well, I think there are reasons to worry, but to understand why, you need to read the right numbers. Because the problem with ratios is this: you can pick a number that fits your view of a company, and that means you're doing things the wrong way around. What we want to know is, what does the number actually say about the company? Okay, because you'll find with ratios that an analyst who wants you to buy the shares can chuck you three that make you want to buy. Someone else who's more gloomy can chuck you three ratios that make you want to sell. So how can you tell the difference and form your own opinion? That's what this video is all about. Now, I'm not going to cover any of the ratios I talk about, any of them in any detail in this video. That's because there are other videos out there that do the job. For example, when I say PE ratio, if people out there are thinking, what's he on about? There is a video, entire video devoted to what is a PE ratio, okay? And there's a MoneyWeek Basics email, that's what I mentioned at the start, also devoted to the same subject if you prefer a kind of written script. Same for price to book, same to EV, EBITDA. So as I go along, if you're thinking, help, stop, I don't understand the ratios, just duck out, take a look at those videos or MoneyWeek Basics emails, and then pop back in again, and what I'm about to say will make more sense, okay? So here we go. Now, I'm going to divide the ratios you could pull out on Apple. I'm going to talk about 8 or 9 of them into the good, the bad, and the ugly, all right? Good means could lull you into thinking Apple is fantastic, okay? Bad means more like the real picture as far as I'm concerned. Signs that the Apple machine might be about to turn, maybe its best days are behind it. And ugly means ratios you can calculate for Apple, but frankly are useless. Because not all ratios fit every single company. One or two of you have asked me about that on videos and said, price to book, can I just use it anywhere? No, you have to be selective. Okay, no one said investing was easy. Now, what are the good, the bad, and the ugly? All right, well, let's start off with the good. If you're making the case that Apple is a massive buy, here are the ratios, and I've drawn them from the 2011 account, so we've actually got the numbers. Here are the ratios you might quote, okay? You might say, well, the gross margin is a whopping 40%. Now, those people thinking, what's a gross margin? Okay, do take a look at my video, What is Profit? But essentially, that is a tremendous profit margin to make on your basic trading activities, making stuff and selling it, all right? So that's great, and it's been going up year on year too. Oh, fantastic, looking good. You might turn to the operating margin. So this is the margin. A margin is just a return, basically, as a percentage. This is the margin you make when you take out Apple's overheads, all right? So this is just buying and selling. This is the margin you make by considering overheads too, and that's a meaty 31%. 31% is high. I mean, to give you some sort of idea, a comparative retailer, you know, somebody like a Tesco or a Sainsbury's will be happier with like 6 or 7% at that level. M&S might be pushing into the 8, 9, but not 31. 31 is magnificent, okay? Not many businesses can claim a 31% operating margin. And you might look at something called return on capital employed, which is a kind of profitability according to the amount of capital employed in the business ratio, and that comes out at a pretty decent sort of 40%. Now, so here's 3 ratios. Frankly, if you're looking at these, you'd say in absolute terms, they're positive, they're high, and in relative terms, compared to say the last 4 or 5 years, the trend has been up. So surely, game over, who wouldn't buy a company that's sort of throwing out those kind of financials? Well, here's my answer, okay? Is a stock good value, what I call the bad numbers, is a stock good value is not a function of how much profit it makes, okay? Because you might be about to pay a fortune for the stock based on these sort of numbers. You might be about to pay over the odds for the stock. Yeah, how do you know you're getting a bargain? And for that, you need valuation ratios. Now, I've got lots of videos out there on valuation ratios, but let me give you 3 that I quite like. One is the good old PE ratio. MoneyWeek Basics email and another video on that one, but the PE ratio, let's take a look at that one. That is the share price compared to 1 year's earnings. Now, I'm going to take the latest, okay, the exact number doesn't matter too much, it's more about the trend, but I'm going to take the latest expected 2012 number here, and you're looking at a PE ratio of around 14, okay? Now, the important thing about that is, what I would compare that to, as I suggested back here, is the kind of 5-year trend. What's the 5-year average PE? And we've seen a drop, okay? If you took a sort of 5-year average, the PE ratio has come down from 23 to 14 now. All right, that tells you the market's getting nervous, okay? That tells you the market's getting a little less confident about Apple's ability to generate these huge profit growth in the future. All right, so what I'm saying is the PE ratio isn't off the scale. I mean, in the tech boom, for example, late 1990s, there were NASDAQ companies with PE ratios of 100 or more. So in absolute terms, that's not as big as you might expect for a firm like Apple, and the trend is down. First warning sign, okay? But let's see, I wouldn't just rely on a PE ratio, that's one number. There is no magic number in investing. So personally, I'd look at something called EV/EBITDA. Now, some of you at this point will be pulling out your hair, reaching for the gin bottle, thinking, what's he talking about? Right, but there is a whole video on that. The supplement to the PE ratio, the kind of replacement for some analysts, enterprise value to earnings before interest, tax, depreciation, amortization. It's another valuation ratio, strips out a few accounting funnies, okay? It uses a slightly different measure of profits, but the important thing is the trend. In a way, it doesn't matter whether I measure Apple's performance using bananas, as long as I'm using the same bananas, if you see what I mean. So it's the trend we're after here. And this is around 8. Not as spectacular as you might expect, down from a 5-year average of nearer 13. Now, get in the picture. What's this telling me? This is telling me the market is rightly, in my view, getting a bit more nervous about Apple's future growth prospects. It's not to say it's going to collapse and go bankrupt tomorrow. That would obviously be a silly thing to say. It's got loads of cash, okay, but maybe the kind of growth we've seen in the past is starting to peak. Okay, let's do one more. One more of the kind of bad. Price to free cash flow. If you wonder where I'm getting this from, well, I'm lucky enough to have access to a Bloomberg terminal, okay? Because I don't get out much, I can also crunch these numbers myself if I need to. But you can find most of these numbers, a good number of them on sites such as Digital Look, for example. If you happen to have access to a Bloomberg terminal, that's great too. You'll find them peppered all over kind of share tip reports and so on. But the price to free cash flow ratio, without going into a load of detail on what that is in this video, it's more about the pattern, okay? Round about 13 on the latest reading, down from 17. So you can probably see what I'm doing here. What I'm saying is, on a valuation basis, the market seems to be getting a bit more nervous. And I'm not just using one measure here, I'm using 3. And you may not entirely understand what the hell these 3 measures are, but at the very least you can see they're kind of trending in the same direction. And part of ratio analysis, by the way, is about doing that. You don't just go, oh, one number, thank you very much, I'll assume that's right. You check it by looking at other numbers or looking at the trend. You see, that's what I'm doing here. Now, so far what do we say? We said, look at these numbers over here. Apple might to some people be a buy. It's a good company. It's a good company, but is it a buy? You can't tell from looking at these numbers, even though they're all valid ratios. They do tell you useful stuff. What you need to do is look at some of these and to get what I would consider to be a truer picture. Okay. Now the ugly. The ugly, these are the kind of red herrings, if you like. These are the ratios that I wouldn't personally, and there'll be people out there who disagree with me, by the way, and that's fine. Do feel free to email in and tell me why you disagree. But there are ratios I wouldn't use on Apple at all, but you'll see them published and printed. This is the trick with ratios, got to know what to use. So, what are those? One of them would be the price to book ratio. Round 5 at the moment, who cares? Okay. The problem with Apple is many of its assets are not in the balance sheet. Its brand name, its market share, its employee expertise, okay? Many of the things that someone would pay for are not on the balance sheet, and that skews the price to book ratio. Take a look at one of the latest MoneyWeek Basics emails for a bit more on that one, but price to book, it's meaningless. And a textbook will say, oh, you only buy a share if the price to book is less than 1. But, that's just not going to work on a company like Apple. This is not a property company, it's not an investment trust, okay? So that's one I'd just go, not interested really. Next one, dividend yield. Now, MoneyWeek, we love dividend yields. We like high yielding companies in an era of low interest rates, but really not relevant to a growth stock like Apple. Yeah, there's a projected yield because they've decided to start paying dividends, which they weren't in the past, of 1.7%. But this is not a dividend stock. This is not a stock you buy for a steady dividend stream. Vodafone might be, Apple isn't, all right? So dividend yields tell me really nothing. On other companies they would, on this one they don't. And the last one, just for good measure, the PEG. Now I've written about the PEG ratio in MoneyWeek magazine and elsewhere, and the PEG ratio is the relationship between the current price earnings ratio and the earnings growth rate. And a textbook would say, oh, less than 1 is relatively unusual and makes it a bargain. Not really. You see, the PEG ratio is best used on small, fast-growing stocks. As Jim Slater, who invented it, said, elephants don't gallop. And Apple is a kind of sort of cantering, increasingly stodgy elephant, if you like. I think we'll leave that metaphor just there for now. So basically what I've said here is problem with ratios, you're thinking, God, a lot of numbers. Problem with ratios, you can't just go, oh, I like dividend yield, I'll always use that one. It doesn't work that way. Investing's not that simple. Right? What I'm suggesting is there are more than this. Here are 9 ratios that I could apply to Apple, and they all give a different view. Okay? These give me no view at all. These make it look fabulous, but these tell me, frankly, whether I'd buy it or not. And I've got to be honest, my view, when a company starts releasing adverts that suggest that its product is an extension of the theory of evolution, see how well it fits my hand, it makes me a little bit nervous that they've slightly lost the plot, okay? Me personally. So for my money, Apple right now, fantastic company, you may like the products, wouldn't be top of my buy list. To download this free video to your favourite mobile device, find us on iTunes by searching for MoneyWeek. And the entire video archive is also available free, just visit moneyweek.com.